And YouTubers, TikTokers, Instagrammers love to pull one little piece of data out of context and tell you massive wave of foreclosures is coming 2007 all over again. Our audience, 28 to 44, it's nothing magical. Home buyers are in that age range. Never had a nationwide downturn in prices.
A foreclosure is actually a lagging indicator. If I'm distressed, does my credit score really matter? There's this belief out there in the market that banks want your homes. The banks don't want your homes, guys. They don't. They're not in the business of owning homes. They're in the business of making money.
Wayne Gretzky was famous for saying, you don't skate to where the puck is, you skate to where the puck is going. The reason why we look at this data, we want to know all of the leading indicators, the lagging indicators. We want to know what's happening.
Delinquencies are rising, but is it really time to panic? With headlines screaming doom and gloom, it's easy to assume the worst. Josh, in this episode, we're going to talk about that rise in delinquencies, how it may lead to foreclosures, and what that really means as a buyer, seller, and investor in today's housing market. So Josh, what's the deal with rising delinquencies? Are they going to lead to foreclosures? Let's start there.
Well, let's start with why are people interested? Why do people listening to this show, the educated home buyer, considering buying a home, in the market to buy a home, why is this top of mind for them? And really, it comes down to affordability. We talk about affordability all the time on the show. And what are the three things that impact affordability? Incomes doesn't really have anything to do with foreclosures. Interest rates doesn't have much to do with foreclosures, but home prices sure as heck does. If we go back to that 2007, 2008 timeframe, depending on where you were, you saw a 20 to 50% drop in prices. So if we look, Jeb, right now, affordability is the worst it's been since 1982. And we're about 40% above or below historical affordability levels. So if you say, hey, if we got a 2007 repeat and home prices dropped 40%, problem solved. I can now afford a home where I want to live. So there's a little bit of hope involved there, a little bit of history in folks' minds of what that looks like. And then the last piece, you said headlines, doom and gloom. Both the mainstream media and YouTubers, TikTokers, Instagrammers love to pull one little piece of data out of context and tell you massive wave of foreclosures is coming 2007 all over again, because it's easy to prey on your fear instincts and get you to watch and consume that content.
Well, Josh, let me play devil's advocate. The large majority of our audience falls between that 28 and 44 age, right? So younger millennials, older millennials, kind of that demographic. And the majority of the people that fall into that demographic were, somewhere between 10 and 18, 20 years old during the last housing crash. So there was an impact on these people in some way, right? Some people, their parents lost their home. Other people, maybe not as been as bad, but there was probably stress, there was distress in real estate. And so people saw it firsthand. And when you see something like this in your life, and now here you are, you think it's pretty, why doesn't that just happen again? Prices are crazy, affordability, all-time lows. Let's just reset home prices. So it's not crazy to think that could happen again until you actually understand the fundamentals. And that's really where the conversation goes today is, let's look at the fundamentals. Are foreclosures up? Are delinquencies up? If they are, what does that actually mean? And then taking it a step further, Josh, what does that actually mean foreclosure-wise? Like, what does that process actually look like? And kind of where are we in that bell curve, if you will, if we start talking about the foreclosure wave and all that good stuff?
And before we jump into those numbers, a little bit additional context to what you said. Our audience, 28 to 44, it's nothing magical. Our show is about home buying. The majority of homeowners or home buyers are in that age range. That's the most common age to buy your first home. So whether it's your first or you're a 42-year-old buying your move-up home, that's the majority of the audience. So there's nothing unique about it. But let's look at that timeline. If you're 40 years old, you were born in 1983, in your history, in your mind, we never really had a downturn. So that historical context is the only time you've ever seen real estate prices drop. So you may believe that that's normal. 20, 30, 40, 50% drops in home prices are normal. One of the big sayings in the mainstream media prior to 2007 was, we've never had a nationwide downturn in prices. Home prices have never gone down year over year nationwide. And we say on the show all the time, So what? Houston had seen it before. Southern California had seen it before. The Bay Area had seen it before.
Real
Any
estate's
local economy that
don't
gets
care,
decimated
right?
has
Yep.
seen that. But in general, a correction is 3, 5, 7, 10. A bad one is 15 or 20% downturn in prices. And it usually lasts a year or two. And then that sort of normalizes. You get to a healthier, more affordable market. And then you see the normal long-term appreciation come back in. So before we dive into the numbers of where we are today, I thought it was important to give that context. If you're 35 years old and your only recollection of a housing downturn is a 35% decrease in home prices in your neighborhood, that's not normal.
No, and we're going to talk about those numbers, but before we dive into them, I'd like to take a minute and ask a favor. If you're new to the channel, you've been listening for some time, you haven't subscribed, do us a favor, subscribe to the channel. It lets us know that you like the content, helps the algorithm, all that good stuff. And if you're on a podcast, watching, listening, whatever, because now we have video on Spotify, you can follow us there as well. And, we appreciate the support. So let's start, Josh, talking about Fannie Mae. Fannie Mae, one of the biggest What do we refer to Fannie Mae as? They are a
government-sponsored enterprise.
There you go, a GSE, if you
mortgages.
will.
They're a GSE. They provide guidelines and a framework for how the majority of loans in the U.S. are done.
There you go. And so with that, there's a lot of data because they have the majority of loans out there in the market. So let's talk about it because there's headlines out there, Josh. There's YouTube videos. There's news articles that foreclosures are up, that there's this crazy wave coming. So we always say, the data never lies. Let's look at the numbers. What are the numbers telling us right now?
So 7,791 REOs, so real estate owned, meaning Fannie Mae has 8,000. Doesn't mean there's only 8,000 foreclosed homes in the U.S. It means per Fannie Mae's data. And that was the end of the first quarter. That's down 5%, down from 8,403 the previous quarter and down 9% from the year previously. I don't think down 5%, down 9%, down or up really matters. Those are spectacularly low levels when we say in the U.S., 4 million homes are going to be sold this year. When we factor in new homes, more like 5 million. So when you look at that, these are really, really low numbers. So downtrend, uptrend, just very low.
Josh, I want to take it elementary because I want to talk to the listeners if they have no idea what we're talking about. So let's give a couple of definitions here. When we talk about delinquency, what is a delinquency? Just to be clear.
Delinquency is someone who is at least 30 days late on their mortgage. So let's say whatever, you got sick for 2 weeks, you didn't have any PTO, you couldn't work, so you had no pay on the first, so you couldn't pay your mortgage on the first. If you get money from your family and you pay it on the 10th, you were late, it was delinquent, but it's not considered a delinquency because you weren't 30 days late. Let's say you get the money from your family on the 20th and you pay it and you have to pay a 5% late fee with your mortgage. You are still not delinquent. You were late, you paid a late fee, not until it is reportable to the bureaus at 30 days. And then for these numbers, I don't know if we even went this far in the breakdown, Jeb, they're tracked as a 30-day delinquency, 31 to 60-day delinquency, and then a serious delinquency is 90 days or more.
Okay, so we got delinquency. Serious delinquency means basically you've missed 90 days. They can now file a notice of default here in the state of California. That's essentially how that works. But then talk about the difference between a foreclosure and an REO, just so we're on the same page when we're throwing out some of these terms everybody understands.
Functionally, there's no difference. Foreclosure talks about the process of which the bank goes about taking back that home. It is known as a foreclosure once it's been foreclosed. That property is a foreclosure. The process was a foreclosure. Once it is owned by the bank, it is considered REO, or real estate owned by the bank or lender.
That means the process has gone through. That home has now changed hands, if you will. It's with another party. The bank has now got that property back. So when Josh said in Q1, we had 7,791 homes that were REOs out of how many households do we have in the United States, Josh? 100
The households are huge, but yeah. And as we were doing this, I was like, I overlooked pulling that number. But what's the housing stock? Is the housing stock like 40 million or is it more than 40 million? 40 million sticking out in my head. But anyway, you cut it. I guarantee you, U.S. housing stock, there's no less than 40 million We have 8,000 that were owned as foreclosures by Fannie Mae at the end of Q1. So again, spectacularly low numbers. Those numbers are very low and well below pre-pandemic. So prior to March of 2020, we were at low levels. We're at lower levels now.
And let's dive into that. So actually, those numbers that you just mentioned, Josh, we're actually down 5%. We, at the end of 2023, Q4 of 2023, we were sitting at 8,403 homes that were REOs at that time that had turned into REOs, and then down 9% year over year from Q1 of 2023. So as you mentioned, the numbers aren't going up. They've actually kind of reversed and gone the other direction.
Spectacularly low numbers any way you cut it. I don't think almost a statistically insignificant difference there when we're talking about up 5, down 9, whatever the number is. They're very, very low. It's important to know. So here, loans in the foreclosure process per Fannie Mae decreased year over year from 0.57 in 2023 to 0.46. So less than 0.5% of homes are in the foreclosure process. And I believe they don't define that by how late you are. It's have we actually started the process of attempting to foreclose on you?
And Josh, nobody really cares, right? At the end of the day, how does this affect me? What does this mean? But let's talk about why a foreclosure is actually a lagging indicator. Why, if you're looking at this data at the moment, it's not really telling the story of now. It's telling the story of what happened, what's previously happened. And so by the time foreclosures are actually on the rise, the numbers that are reporting aren't, it's going to take a while for all of that to catch up.
100%. So why is it a lagging indicator? It's because we need to see stress in the economy before you see it trickle down to people making their payments on time. You see GDP decreasing and you go, GDP is a big national number. That doesn't impact me. Well, it decreases because companies are struggling. Companies hire employees to do the work. So when they're struggling, they're going to cut hours, they're going to cut jobs. So people are either earning less or earning nothing. What do we generally look at? What's more of a leading indicator is the unemployment rate. We've seen it go from 3.6% over the last year to 4.1%. So 4.1 is a very low level, but it's up over 20% in the last 12 months. So it bears watching. That's a leading indicator that tells us if we flash forward 6 months, I'll bet you the number of delinquencies and the number of foreclosures will be up as some of those people that are experiencing income stress will then have payment stress with their mortgage.
No, and I think it's important to note that, if you do lose your job, we actually didn't go as deep as we should have on some of this outline, Josh, and talk about the amount of equity out there in the system. But
no, we've got it. It's all there. It's all there. We'll get to it.
Yeah. So let's talk about why, the slowing economy, the layoffs of jobs. What does that actually translate into when it comes to this distress situation? Because I think we need to be really, really clear. In order to see foreclosures, in order to see house prices actually reverse course and go back, in any, what's the right word, Josh? In any, I have no idea what I'm talking about here.
Significant way.
I mean, you could say significant, but I mean, I was looking for a different word, but nevertheless, significant way. You've got to see distress in the system. You've got to see people willing to walk away to some degree, and that's not going to happen for a number of reasons.
Well, let's look at. We'll just jump ahead and go into those numbers. So right now, 39% of homeowners own their home free and clear. If you don't have a mortgage, you can't get foreclosed on, right? Mm-hmm. I mean, technically there can be a tax sale if you don't pay your property taxes, but statistically almost impossible, near zero for those people to lose their home to foreclosure. Of the 61% that have mortgages, 96% of them have a fixed rate. So they're in no danger relative to 2006, 2007. We had about, I think it was 35, 40% of mortgages at that time were adjustable rates. So you don't have adjustable rate risk. 96% of them are a fixed rate. 76% of them have an interest rate below 5%. So you're like, oh, that sounds pretty good. Let's like double down on those numbers. ICE Technology, they do their mortgage monitor, said the average CLTV, combined loan to value, all mortgages against the property as a ratio of the value of the property is 44.6%. So most people owe 44% of what their home is worth with a fixed rate under 5%. So 2/3 of all tappable equity is held by homeowners with credit scores of 76%. So tappable equity, they consider the equity you have up to 80% of the value of the home. So if we say the median is 44%, there's about 35% of tappable equity. Well, 2/3 of that is held by households with 760 or higher credit scores. We could have gone down the rabbit hole of recent vintage of both Fannie Freddie, FHA, and VA mortgages and what median credit scores look like during or leading up to the great financial crisis. FHA and VA loans had median credit scores in the low 600s. Now they're all high 600s, low 700s, and Fannie Mae is more like 740, 750. It varies over time.
But explain what that means. Like why is a 700 credit score borrower, 760 credit score borrower any better than a 600 credit score borrower in a situation when it comes to distress? Like if I'm distressed, does my credit score really matter?
It tells you how these people generally have handled their finances. And the reason why credit scores were created was as a measure of the probability of risk of lending to them. I haven't seen this number in about 10 years, but at one point, the risk of someone with a 740 credit score of losing their home in foreclosure was measured at like 1 in 1,000. If you go down to a 620, it was like 1 in 8. That's the difference there. So you've made videos on your channel, Jeb. FHA will allow FICO down to 580. VA doesn't have a minimum FICO. That's cool, but in the real world, there are almost no loans being done to those people. So when we say 2/3 of all tappable equity is held by people with 760 credit scores, first of all, if they get in trouble, they can probably get a loan against that equity. They're less likely to get in trouble, and that measure sort of encapsulates many other things. You could have an 800 credit score and not have a dime to your name. Just say, hey, I have very minimal debt and I've managed credit in the past. But in general, those people also have some reserves, some assets. They're older. They may have a 401k and another retirement account they could lean on when it comes to a time of distress. So and then we have here another 2/3 of that is held by homeowners with first lien mortgage rates below 4%. So we said 96%, or what was the number? 76% are below 5%. In terms of that tappable equity, 84% of them have rates below 4%. So we led off the show, Jeb, saying, why do people want foreclosures? They don't want foreclosures. They want lower prices. They think foreclosures will give them lower prices and higher affordability. But let me ask you a question. How affordable would a home be if you could buy it at 44% of what it costs now and your interest rate was under 4%? It's very affordable.
Oh, absolutely.
So now imagine you're that homeowner with a 44% loan to value and a 3.5% interest rate. What does your mortgage payment look like relative to any other housing situation you have besides living with family rent free? It's way lower than rent.
Significantly less. Yep.
Way less. So these people will beg, borrow, steal, scrape, anything they can to stay in their home, because moving out of their home and moving into an apartment is probably going to cost them more. So people don't like doing that, don't want to do that. That doesn't mean that if husband and wife both lose their jobs and they didn't have any reserves and they don't have any family with money to lend them, can't become a forced sale. But again, in this situation, Jeb, what happens when someone has 50% equity in their home and they can't make their mortgage payments? Do they lose that home to foreclosure?
No, they sell it at market value. And I think that's where people kind of get mixed up. They're like, hey, well, when people lose their jobs, that's when all these foreclosures happen. Okay. Well, what you have to understand is that people have to live somewhere. So you either have to rent, you have to own something, or you live with family rent free. And I guess, from my perspective, most people aren't going to go that direction once they've owned a home. And then we said earlier, I forget the actual number, but it's something like $17 trillion of equity out there in the system, something crazy. It's a big number, between all homeowners out there. So what happens is the majority of homeowners at one point, during the last couple of years had something like $200,000 of tappable equity. And that's assuming that a 20% LTV and
the most
80%
recent
loan
one,
to
Jeb,
value
is $299. The median homeowner's tappable equity is $299.
$299,000. So if you've got $300,000 of equity in your home, let's just say you own a $1 million home. You've got $300,000 of equity in that home. When you go to sell it, are you just going to sell it for what you owe on it, $700,000? Or are you going to try to actually sell it for what it's worth? Well, at the moment, you've got low supply. Demand is also low, so we're not discounting that. But there is room there to sell that property at market value, and not have to deal with the distress, the foreclosure, the process of walking away from your home. And I think that's where people get confused.
Well, Jeb, let's spell it out in super simple terms. You own a home. You have 30% equity in your property. Let's say, to make the math simple, a $500,000 home, and you have $150,000 of equity. And you've come to the conclusion you lost your job, your wife no longer likes you, she's taking the dog and she's moving out, and no one wants the house. So we've arrived at a point where we have to sell. That's put a sign in the yard and get it done. Mm-hmm. It's not a foreclosure unless someone says, I'm going to be vindictive. My wife left and took my dog. I'm going to sit in this house and I'm not going to move and I'm not going to make the payment, and the bank's going to have to come pry it out of our cold, dead hands. It only becomes a foreclosure.
And I'm just going to give up that $150,000 in equity. I don't care about it.
Because I don't want her to have it. So right. You have to be illogical, irrational, crazy for that to be a foreclosure. Let's go to the opposite end. And let's say you just bought it last year, and you put 3% down and the home's gone up 1%. So there's less than 5% equity. We've talked about it before. It costs 5 to 8% to sell that house. Does that become a foreclosure? Not necessarily, because you can ask the bank to do a short sale. Short sales have less loss severity for the lender. Mm-hmm. So if they're smart, they're going to look at it and they're going to cooperate, or they're going to go through and figure out how to minimize their loss in this situation. And that is generally a short sale. So we have the potential for a standard sale. If you don't have enough equity, you can have a short sale. If we don't have either one of those things, does that guarantee that it goes to foreclosure? Again, not necessarily, only if someone is completely crazy and obstinate. The two things that we didn't talk about, Jeb, we get questions all the time, or did about a year ago. FHA and then Fannie and Freddie followed up. The FHFA approved 40-year loan modifications. And why did they do that? Because post-pandemic, most people have a 5% interest rate, a 3.5% interest rate, a 4% interest rate. So mods during the great financial crisis, a loan modification is, hey, you have a 7% interest rate. It's adjustable. It can go all over the place. We're going to fix this thing for 10 years at 2%. That was what a modification looked like. Now, we don't really have anywhere to go down on interest. So they said, hey, let's stretch them out to 40 years. Again, with very, very little distress. We have a listener to the show that we did a purchase for 2.5 years ago. Almost immediately on moving into the home, the relationship went sideways. Husband moved out. She goes down to a single income. What happened? They had a 3 1/8 interest rate. She called the servicer, and in like 2 weeks, they sent out the modification agreement to stretch it out to 40 years. So the payment went down. Her sister moved in with her, and that home's never going to come to market. So that is very, very common. I have a wholesale lender that I work with that they service all of their loans. So they have a department that deals with this, that deals with Fannie, Freddie, FHA, and they are told, you work this out. We don't want foreclosures. We don't want to have real estate owned. So go through everything you possibly can to work with these people to keep them in their homes and making whatever payment they can. And Jeb, if we go back again, during the great financial crisis, the banks who were getting bailouts from the federal government were saying, we're not bailing out homeowners because that's a moral hazard. If we do that, then the next guy is going to come along and think someone's going to bail him out. 15 years later, we're 180 degrees opposite of that. We realized that you saying, hey, I'm going to hold the homeowner's feet to the fire so that the next guy knows that I'm serious about foreclosing on him. They said we had a wave of foreclosures. And instead of a 20% downturn, we had a 40% downturn. So they realized that keeping more people in their homes and not having a flood of supply come to the market keeps home prices higher and allows them to see greater profits, less losses over time than foreclosing on people. So that's where we're at. Most people have a ton of equity, not going to get foreclosed on. If they want to stay in the home and there's a reasonable way to make it happen, the lender's going to work with them. And if all else fails, the majority of people have equity will put a sign in the yard and sell their home, which, I mean, talk about this, Jeb, that is additional supply. A forced sale is additional supply. So we talk about the possibility for a correction in home prices, and that's 3, 5, 7, 10%. That's by additional supply when we have distress coming into the market. So that can't, what we're talking about is not a foreclosure, but it can lead to downward pressure on prices. But it's not this wave of bank-owned properties that banks don't want to own properties, and they put a sign in the yard and sell it for whatever they can get for it.
No, and we've talked previously too how at the time of the financial crisis, rents were obviously a lot less. So, going from one payment to the other made a lot more sense, giving up your adjustable rate mortgage at, that was interest only or negative amortization back in the day. It made sense to just say, hey, I'm walking away. I have no equity in my property. This house isn't worth keeping because I can go rent the house across the street in the example that you've used several times for half of what I'm paying on my mortgage now. You don't have that. What you still have is rents rising. You have a market full of people with equity. You've got fixed rate mortgages at some of the lowest rates that we've ever seen, and a lot of cash out there in the system, a lot of equity out there in the system. But Josh, we're not naive enough to think that foreclosures don't happen. They're going to happen. There is going to be a slowing economy. People will lose their jobs. There are people, like you said, that put 3-5% down, haven't seen the appreciation that the people that purchased at the early part of the pandemic have seen. And so there's going to be people that walk away, that can't make their payment for one reason or another. So let's take a minute here, just kind of talk about how that process works, because I think it's important to understand how foreclosures work and what it actually means for the market.
In the context of this conversation, it's important to understand the timeline, Jeb, because we're seeing delinquencies are really, really low. So we say that's a lagging indicator. Those will go up, but when they go up, that doesn't mean the foreclosures are going to go up right away, because foreclosure takes a long time. So let's start with a non-judicial foreclosure. For us in California, we use a deed of trust. The deed of trust gives the lender the power of sale if you don't follow through on your terms of the agreement. So basically, you get behind, they file a notice of default. It says, hey, we have a deed of trust that says what our agreement is. You're not meeting the terms of the agreement, so we're making a notification that you are in default. We put it in the public record so everyone can see that, and you have 90 days to cure that default. After the 90 days, they can, but they're not required to. They can file a notice of trustee sale. It says, my deed of trust says I have the power of sale. I can sell this property without your permission at the courthouse steps. So if they file that notice of trustee sale, you have 21 more days to cure that default. And there's many things you can do in that time frame, from the NOD to the NOT. You can ask for forbearance. You can ask for a modification. You can file bankruptcy and push all this off. So we're saying at 111 days in California is the earliest a bank could foreclose. So let's call it 4 months. We told you banks don't want to foreclose right now. So it's going to be a lot longer than that, but they could at the earliest in 4 months.
And here's something I want to be clear on. If you're going through the foreclosure process, if you ever get to that point, communication, the thing that you don't want to do, is your best opportunity to get out of that situation in a way that's going to benefit you, right? More beneficial. What people think is, I've missed my payments. I'm not going to talk to the lender. I'm not going to have conversations with anybody. Just going to hole up. And when they kick me out, they kick me out. The wrong approach. The right approach is to call the lender before you get to that situation and say, hey, listen, this is where I'm at. I can't make the payment, or whatever your situation is, and be an open line of communication, because like Josh said, they're likely going to work with you. It is much less expensive for them to modify your loan, for them to help you, than it is to go through the process of foreclosure. There's this belief out there in the market that banks want your homes. The banks don't want your homes, guys. They don't. Otherwise, they would keep all the real estate that they foreclose on. They sell it because they're not in the business of owning homes. They're in the business of making money, and they lose money every time a foreclosure happens. So a little bit of sidebar there, Josh, but I think it's, if you're listening to this, you're probably not in foreclosure, but maybe you know someone who is, tell them.
It's an important message, because we do both agree the economy is going to slow. We may end up in recession. There's going to be some people that find themselves in that situation, but they have a lot of options. Unlike 2007, 2008, they need to talk to their lender, talk to their real estate professional, and talk through that. But back to a non-judicial foreclosure state, let's be realistic. The lender's going to let you get 2, 3, 4 months behind before they file that notice of default. So now we got 3 more months on that notice of default. They're probably not going to file the notice of trustee sale immediately. Even at that, now 21 more days. So we're talking, I would say, 6 to 12 months safely
Easily
in the states that can do it quickly, if someone was very motivated to foreclose on your property. So now let's talk about Florida. It's a judicial foreclosure state. So when you sign your loan documents, it's a little bit misleading that I say I'm in the mortgage business. I do mortgages. I should say I do deeds of trust. Most of the states that I operate in, you're going to sign a deed of trust. But if you're in a judicial foreclosure state, you sign a mortgage. A mortgage does not have a power of sale. It's still an agreement between you and the lender that you're going to repay them what they owed you at a rate of interest over a certain period of time. When you default on that mortgage, they have to file a lawsuit. That lawsuit is a very different process, and it takes much, much longer. We were seeing 3 and 4 and 5 year timelines in Florida during the great financial crisis. So again, lagging indicator, we're not seeing anything showing distress in the system yet. We do believe the economy is slowing. We do believe we'll see those numbers pick up. If and when they do, it's a long timeline, and most of the people have lots of options short of foreclosure. So if you watch some moron who has a giant YouTube channel, who for the last 5 years has been telling you he's found the one piece of data that says starting next week, foreclosures are shooting through the roof, have them show you the data. Look through the data. The data tells us that's not how it works. That's not what the numbers are telling us. And if and when it does happen, it will be very moderate relative to the great financial crisis that they're holding out as this boogeyman to tell you it's coming, and it's going to be worse. It's going to be worse this time.
And even then, if and when it happens, foreclosures happens, guys, it's not nationwide. It's not every market's not going to have all these foreclosures at one time. What's going to happen is you're going to see the markets where inventory has risen the most, demand has slowed the most. You got the most homes on the market at one period of time. People can't sell them for one reason or another. Slowdown in the economy. There's a lot of things that happen at once, but it's also in those markets that probably saw the most appreciation. Now they're seeing the biggest pullbacks. They're seeing inventory grow. They're seeing costs rise because of insurance and other things out there in the market. So understand, if you're a buyer out there looking for these opportunities, they're going to be localized. It's not going to be everywhere all at the same time, and you're going to be able to buy all these properties nationwide. Some markets are going to have more than others, but even then, we talk about it, Josh, real estate's local. So if you're a buyer out there in your market, or in a market, rather, pay attention to your market. Pay attention to your data. You can't have foreclosures increasing without a dramatic increase in inventory. And where you're going to see that uptick first is in new listings data. New listings data at the moment is trending at the lowest levels we've ever recorded. So you can't have new listings going down and foreclosures going up at the same time. It doesn't work like that. So in order to see a noticeable spike in foreclosures, you've got to see that noticeable increase week after week after week in new listings.
Jeb, that local nature and knowing your market, we hammer it all the time, wherever you're at. If you're a homeowner in danger of losing your home or needing to sell your home, it's important. We didn't want to club you guys over the head with a bunch of repetitive data. MBA runs numbers, ICE has other numbers, but I do have some numbers here that along the local nature of this, it's important. Right now, the top 5 states by non-current percentage. So in any stage of default, haven't made a payment, could be all the way up to foreclosure. Mississippi's at 7.5%. Louisiana, 7.25%, Alabama, 5.2%, Indiana, 4.7%, West Virginia, 4.6%. And again, out of context, you go, ooh, that sounds bad. Well, is it? I don't know. They're all relatively flat year over year, except for Louisiana. And the peak for each of those states, which was somewhere between 2005 and 2010, was 23%, 30%, 14%, 15%, 15%. So way, way off those peaks prior to the great financial crisis. And then the bottom 5 states by non-current percentage, California, Idaho, Montana, Washington, Colorado, and they're all between 1.8 and 2%. And their peaks were at 16%, 10%, 8%. 10%, 8%. So just, it's not there. It's not in the data. I am happy to go where the data takes us. And we hope you guys show up here every week and listen to us, because we aggregate a ton of data. So Wayne Gretzky was famous for saying, you don't skate to where the puck is, you skate to where the puck is going. The reason why we look at this data, we want to know all of the leading indicators, the lagging indicators. We want to know what's happening. Like, it is important for you. You're listening because for you as a home buyer, potential home buyer, home seller, that you want to know what it means for you. Well, imagine Jeb and I are not just homeowners, not just real estate investors. Our livelihood, our ability to put food on our family's tables, to keep a roof over our head, depends on knowing where this is going. And we are happy to figure that out for ourselves, to figure out where the opportunity is, where the potential roadblocks and problems are. And we love sharing that data with you guys.
Yeah. And so if you're a home buyer out there, you're somebody going through the process, thinking about going through the process, not sure where to start, we actually created a referral link where you can work with our team here directly. We can, we would love the opportunity to guide you through the process, help you make the best decision for you and your family. And, while I guess we help you become the educated home buyer. So if we can be of assistance to you, do us a favor and hit that referral link below. So Josh, advice of people in the market at the moment, whether they're waiting on foreclosures or not, what do you say?
Foreclosure should have nothing to do with your buying decision.
Agreed.
Buying a home is either right for you at this point in your life or it is not. And we've done entire episodes on this and helping you determine that. It is not right for everyone at all times. And we are looking, in a perfect world, I will say everyone that I know should have bought in 2010. For many of you listening will say I was in third grade in 2010, so that's not very helpful advice. But then after that, 2020, right before everything spikes, we would have got super low interest rates or been able to refinance to a low interest rate, and we would have benefited from this 30, 40, 50% run up in prices. So those things are gone. We are definitely at a point in the market where you have to be on point. You have to make good decisions. Jeb, you had a buyer in 2020 buy the absolute wrong house in the wrong location that he, his family, everyone told him, do not buy this house. And 3 months later, 6 months later, they got to sell it at a nice profit and go buy the house they wanted. This isn't that.
It was a little bit longer. It was a little bit longer. It was almost 2 years.
Okay.
That they had it, but made a huge profit. Yeah.
Made a huge profit. Yeah. We're not in a market where you're going to get that get out of jail free card and get to start over. So you need to become the educated home buyer, make the right decisions, determine that, yes, it is right for me. I am committed to this. I have a long-term time horizon. I have a stable life, financial foundation, career, and am ready to do this. And if so, foreclosures have nothing to do this. We're not getting a get out of jail free card in terms of home prices dumping 30 to 40% and you being able to get in at a much more affordable level.
And I'll add to that saying, trying to pick the top or the bottom is a fool's game. You never win doing that. You buy when it's the right time for you. You have a longer term time horizon. You make your payments, you live your life. And guess what? You look up 10, 15 years later, you've got equity in your property. You've got money you've put into a forced savings account, and better yet, you've fixed your housing payment for that period of time. You don't have to worry about rent. You don't have to worry about increases in other things going, making, you go crazy and emotional and all of that good stuff. So really just focus on when it's the right time for you and become the educated home buyer. Until next time, guys, buy right, borrow smart, build wealth. Adios.
Amigos.